what would cause a liquidity event for private investment and the different ways that that can happen, and some of the considerations you might have about taking profit. Most of the time when people make a private investment, it is in the equity of a company. Some of the platforms that you can do that on would be like Equities In, Forge, Link2. In that, you can purchase equity in privately owned companies before they IPO or go public. So that is one of the ways that you could experience a liquidity event for a private investment, would be that a company would go public. And in that, they would have to file an S1. So that'll get approved by the SEC. They would then get listed on a stock exchange. If they do an IPO or initial public offering, oftentimes in the S1, they will designate a lockup period. So if you were somebody that was on the cap table previous to them listing the stock on the public market, either here in the US or abroad, the investment banks, they'll go out to them and they will dilute the shares. So they'll issue new shares, they will sell that to the investment banks. The investment banks would then sell that to their patrons or clients. And because of that, they basically cater to the investment banks. And the individuals that owned stock previous will be subject to a lockup period. Oftentimes, it's anywhere from 90 days to a year sometimes before you can liquidate your shares onto the open market. And so that's kind of not advantageous, right? Especially, oftentimes an IPO will come out and you'll see the price sell off or fall before the people that were in previous to the IPO are able to sell their positions. But that's also the investment bank's way of hedging themselves so that their clients get priority, and those they may have held beforehand, they get diluted a little bit. And it's also great for the previous investors of a company and an IPO, but the founders and executives for the company, they often do very well as the investment banks. Another way that they can go about it and still list their equity on a public exchange would be a direct listing or a SPAC. There's a few other ways that you could get listed on a public exchange, but we'll talk to a direct listing. So that's where they take the people that were in previous to the IPO or the direct listing onto the public exchange, and they're able to sell their shares onto the public and retail, and their ability to purchase them. One of the recent ones that happened like this was Coinbase. Oftentimes, if a company already has a lot of retail investors that understand their business model or would want access to the equity, and they've done a really good job of marketing themselves to the public, they don't necessarily need the investment bank's buy-in. And in those situations, that's where you might see a direct offering. Coinbase did this last year when the crypto market was at the top or close to the top. I know from some of the people that I am aware of, they got in somewhere around $30 and $40 a share. And so they did pretty well, 10x return on their capital. Now, that's not always the case. And again, if they had IPO'd and there had been a lockup period, that stock did fall off pretty heavily. Even now, those people are still up on their original investment, just not anywhere near as much as it was. That's one way that you can do it. Another way that you could have a liquidity event, if your company is still private, is there's an acquisition. And in an acquisition, they could be acquired by a public company or a private company, and you would then be issued shares in the new company at whatever ratio was designated during that acquisition based on the valuations. And you could liquidate or you could hold, whatever you chose to do at that point. But those are kind of the three main ways that companies will have a liquidity event. There are some outside circumstances that occur occasionally where a company could buy back shares, if they felt confident they were going to IPO at a higher price than what they were willing to pay people. They could provide liquidity to shareholders that have been in the investment for an extended period of time. Oftentimes, if you get beyond, the 5, 6, 7-year mark, that's when companies look at this option, and sometimes they'll buy back at a premium in comparison to what some of the shares are selling for on the open market. The company that's currently doing this or has done this just recently is Ripple. They've bought back shares, I believe, at around $60 from some employees, as well as Series C. And and then also some previous series as well. So that tells me that they're likely confident that when they do IPO, they will be at a higher valuation than what they bought the shares back at, and they'll be able to sell those shares onto the market or to the investment banks when they IPO or do the direct listing on whatever public exchange they decide to do so. I did say that we would talk about, the tax ramifications that are involved with that. Now, if you are holding the private equity, your cost basis and the time frame are going to be designated when you purchase that equity. It does not change your basis or time frame when it goes public. You would just, hold if you decided to do so. Now, if you do sell the equity at that point and realize the gains, you're going to be taxed based on your cost basis and the time frame held. So let's say, you bought stock in a company that IPOs 3 years later. You've held that for at least 3 years. It's going to be capital gains tax. If you do sell that position onto the open market, and at that point, you're going to realize those gains. Let's say you made 10x on that. That's going to be 20% tax implication on the profit that you've made for that investment. So let's say you invested $100,000, you make $900,000. You're going to be taxed at 20% on the $900,000 that you made, and that'd come out to about $180,000 that you would owe in taxes. There's not a 1031 exchange for private equity, unfortunately. You can do that with real estate. So if your investment was in real estate and you wanted to roll that to another property, you can defer those taxes by rolling the capital gains that you would have made on the original property into the down payment or purchase of another property. And there's a process that goes along with that, and you have to designate, what property you intend to purchase within 6 months, and there's other components there. But that's one way that you can mitigate some tax implications on real estate. Really, the only way to do it for private equity is going to be, using a trust or an LLC or a corporation to make your investments through. And then the profits that you take from that could then be, used within the corporation in some manner to offset those tax implications. What I most often see, you might, donate that capital or a portion of it to a cause that you feel is righteous or sufficient. You might purchase a vehicle or a piece of equipment that's over 6,000 pounds. You can use Section 179 of the tax code to depreciate up to 80% of that purchase in the same year. You can also utilize life insurance and key employee insurance if you wanted to remain liquid, and an infinite banking concept. There's a lot of different tax codes, and always consult with your CPA. Just want to make that disclaimer here. Nothing said here is financial advice. Always consult with your financial advisor before making any investment decisions. Anything said here for tax, legal, or financial is for entertainment and educational purposes only. And just want to make sure you consult with a professional before making any decisions. And the other piece there that I didn't mention is you just hold, right? If you just held the stock in perpetuity, there are ways that you can leverage loans against those stocks, and those don't have any tax implications. You might also receive dividends depending on the company in the long term, which would be nice income to have, especially if you accumulated a large amount of stock early on. Bank stocks tend to pay dividends. Other financial institution stocks tend to pay dividends. So just some thoughts around that for passive income and other ways that you could defer or remove tax implications on these investments. So with that, if you haven't liked and subscribed, please do so, and we'll see you guys on the next one.